Take a look at this crowded lecture hall. You're looking at the exact environment where Takeshi Kotegawa started his career. He was a normal college student without a massive bank account or a taste for luxury, yet he would go on to quietly pull billions out of the stock market. In Japanese society, the standard path is highly defined. You study hard, you get a secure corporate job, and you build a stable career. Stepping outside that structure to trade stocks is considered incredibly reckless. Kotegawa ignored that pressure entirely, treating the market as a perfectly logical system waiting to be decoded. When a trader manages to pull billions out of the market from a bedroom, the search for a specific indicator begins. Amateurs comb through the history, hunting for a hidden pattern, a magic strategy, or an insider tip that explains the returns. But the breakdown usually happens at the execution level. Even with a profitable plan, many traders find themselves paralyzed by a growing loss or overcome by the urge to take a tiny profit far too early. These are the small daily decisions that separate a legend from a statistic. To understand how Kotegawa built his wealth, we have to look past the flashing numbers on the screen. The real story is found in the unyielding, repetitive routine he put himself through every single day. His preparation began by actively shutting the world out. Before the market opened, he stayed completely away from financial news, social media, and outside opinions. He understood that reading the news doesn't give you an edge, it gives you a bias. Every morning, Kotegawa erased the overconfidence from yesterday's wins and dropped the heavy burden of any losses. He started every session at zero. This diagram shows a trader's emotional state, starting highly volatile before flatlining into perfect balance. We usually think fear causes mistakes, but Kotegawa identified excitement as the real threat. Excitement breeds greed, leading to impulsive risks that destroy the portfolio. Compare that blank slate approach to an average amateur logging in at 9 a.m. They are often vibrating with adrenaline, desperate to recover cash they lost the week before, or eager to prove to themselves that they are smart. Starting the day with a biased or emotionally charged mind makes reading a stock chart impossible. No strategy can function if the person behind the keyboard is reacting to their own internal noise instead of the market. During active market hours, the environment is intense. Yet Kotegawa spent the vast majority of his day staring at his screens doing absolutely nothing. He could sit for hours observing thousands of price ticks without ever clicking the buy button. This chart shows how Kotegawa actually read the market. Instead of tracking dollar amounts, he tracked human behavior. Every spike and crash was a real-time language mapping out mass panic, raw greed, and total despair from other traders. This graph demonstrates his core rule. If the price broke upward, he waited to see a massive surge in volume underneath to validate the move. If that volume validation wasn't there, he did nothing. Choosing not to trade was a professional decision. It is the same discipline you see in MS Dhoni. He doesn't swing at every single ball. He stands perfectly still, absorbing the pressure, waiting for the exact delivery he knows he can hit. Most traders force bad trades purely because they are bored and need the dopamine hit of being in the market. Kotegawa took that boredom and weaponized it. He used it as a filter to silence the noise and protect his capital. When he finally did enter a position, his execution was completely mechanical. There was no intuition, no guessing, and absolutely no hope. Every move was dictated by a plan he finalized before putting a single dollar on the line. If a trade went against his thesis, he cut it, instantly. He never hesitated or bargained with the screen, hoping the stock would miraculously turn around and save him. He managed to do this by reframing how he viewed losing money. A loss wasn't a personal failure or a bruise to his ego. It was a neutral data point, a routine business expense required to keep his operation running. Above all else, he followed a strict rule of survival. Never risk the entire account on one idea. It did not matter how perfect a setup looked. Preserving his capital to trade another day was always more critical than capturing a single massive gain. Long-term money management does not require you to perfectly predict where a stock will go tomorrow. It requires you to control your own ego today, so you can walk away and swallow a small loss. When the closing bell rang, Kotegawa didn't log off. In fact, his most crucial daily habit was just starting. He spent his evenings conducting a brutal, honest review of everything he did that day. His review focused on both the technical behavior of the stock and his own mental state. He tracked his fatigue and levels of focus as closely as he tracked his entry and exit points. This matrix compares whether rules were followed against whether a trade made a profit or a loss. Kotegawa measured success purely by process. If he took a financial loss but he perfectly executed his rules, that quadrant glows green. He considered that a successful day. Conversely, if he made a massive profit but acted impulsively and broke his own rules, that quadrant flashes red. For him, making money the wrong way was a failure. This metric is what separated him from the amateur mindset. A trader is never actually fighting the charts, the algorithms, or the breaking news. Mastering the market is impossible until you realize you are only ever fighting yourself.